market. Very interesting. We know that there's some market changes, so I'm going to rattle through this. So Sydney is down 0.2 for the month, down 0.5 for the quarter, and is still showing a positive annual rate of 3.3, but marginal. Melbourne is down 0.4 for the quarter, down 1%. So that's significant. And annually, Melbourne is down 2.3%. So that is the start of heavy downturns in Australia, with Melbourne leading the way. Brisbane showing a positive month, 0.6, quarter 1.8, and an annual growth of still 12.1, which is good, but heavily slowing. Adelaide 0.8, 2.8, 14, heavily slowing. Perth still showing the biggest growth of 1.1 for the month, and 3% for the quarter, still showing a 21% growth, but also on a trend and trajectory downward. We'll talk more. Combined capital cities, 0.1 growth, 0.3 quarter, still showing a 5.4 growth for the 12 months, with Perth holding that up massively. Otherwise, it would be flatlining. Combined regional, 0.3, 1.1, and 6% respectively. So nationally, for those who quote national figures to your sellers, 0.1%. You don't get closer to a flat line than that. 0.1% growth nationally, all right? For the month, 0.5% for the quarter. You don't get much closer than that, except 0.1. And still showing a 5.5% growth annually nationally. So yeah, I think this will be the last, we might see annually a slight growth in January, but we're going to see negative growth rates nationally in January. I can almost guarantee it. Okay, so what does that mean? Let's have a look. So CoreLogic's national home values, that's where I get my info from, rose by just 0.1% the last month of spring, the weakest Australia-wide result since 2023. This marks the 22nd straight month of growth, but it could be close to the last in the cycle, as I mentioned. The downturn is gathering momentum in Melbourne, Sydney, while the mid-sized capitals, which have dominated the growth cycle of late, are also losing steam. Melbourne, where housing values have fallen over 10 of the past 12 months. I'll repeat that. So Melbourne, where housing values have fallen over 10 of the last 12 months, is certainly a big indicator. Sydney, August likely marked the peak of the cycle. On a rolling quarter basis, we're now seeing 4 of the 8 capitals record fall in values, led by Melbourne. The mid-sized capitals and most of the region's rest of state markets continue to provide some support of growth, which is Adelaide, Brisbane, Perth. Perth's pace of capital gain continues to lead the nation, with values up 1.1 over the month and 3% higher over the rolling quarter. However, this was the softest rise over the rolling 3-month period since April 2023. So softening. Outside of capital region, housing trends have been a little stronger. Regional's a little stronger. For those of you in regional areas, weaker housing conditions have been accompanied by rebalancing in available supply. At the same time, purchasing activity looks to be winding down. Let's have a look at, that's the wrap up. Let's have a look at the rental side of things, and then we'll go. I want to look more today at why the slowing is happening, to give you guys some nuts and bolts to talk to your sellers and actually give some actual facts. But let's have a look at the rental market, because obviously we work with offices and rentals and BDMs, and they're a very big part of our business. So the National Growth Index has continued a relatively flat, it's a relatively flat run of growth, rising only negative 0.2 in November to be 5.3 higher over the past 12 months. rental appreciation is slowing across most markets due to a combination of lower population growth, especially with less net overseas migration, but also a gradual recovery in the average household size, which is helping to moderate rental demand. With both housing values and rents leveling, if not falling, gross rental yields have also firmed. So that's interesting. And we'll probably call upon someone in our rental. Jelena, we'll cross over to you to see how you faring, even though you're regional, which is probably a little stronger, and UWA, which is a little stronger. But I want to come back to you after this and just see what trends you're seeing. So, but we'll get that in a second. So let's look deeper into the whole national markets. So what I've thought we can report is the outlook for housing markets has arguably deteriorated over the past month, with core inflation holding high, labor markets holding tight, and the chances of a rate cut early next year becoming less likely. Not to mention the rising geopolitical risk. So we're going to talk about what's happening early next year with regards to an election, which we know puts a freeze on the real estate market. So we do have some headwinds coming early next year. Playing the waiting game on inflation, the October inflation indicator came in at a healthy 2.1% for October, well inside the RBA's 2 to 3% target range. But we know the RBA will be looking through the headline results and focusing on the core inflation outcome. Unfortunately, the trimmed mean moving in the wrong direction in October, nudging higher to 3.5 from 3.2 a month earlier. While the monthly inflation indicator doesn't provide a complete read on CPA, it's a reminder that the last mile of getting inflation sustainably within target remains a challenge. So we are still struggling with inflation. So we were correcting it, going in the right direction. Recently, the October inflation indicator has changed course. Labor markets are another important consideration for the housing market and interest rate outlook. The unemployment rate has leveled out in the early 4% over the past 7 months, with participation in the workforce holding around record highs and underemployment trending lower. While strong labor markets are a welcome outcome for most Australians, the risk in a tight job market could keep additional upward pressure on wages, which could in turn fuel consumer spending, supporting higher prices. It's been a year of two halves. Financial markets are pricing in a rate cut around the middle of next year, while economists from the big four banks are expecting rates to drop sometimes between February and May. Until interest rates come down, it's hard to see the weakening housing trend turning around. It's a very, very key point. I'll repeat that. Financial markets are pricing in a rate cut around the middle of the next year, while economists from the big four banks are expecting rates to drop sometimes between February and May. Until interest rates come down, it's hard to see the weakening housing trend turning around. Now, with an election, and we don't know when exactly that's going to be, that's going to affect what happens to the rates as well. A lower cash rate will be a positive factor for housing markets. Mr. Lawless said lower mortgage rates will provide a lift to borrowing capacity, and along with lower inflation, should see an improvement in serviceability assessments and see a further rise in consumer sentiment. A couple of rate cuts might be enough to shore up a declining trend in home values, but it is hard to see any material upward pressure returning until interest rates reduce more substantially and affordability barriers are less formidable. A couple more things. Alongside the uncertain economy outlook, housing markets are likely to be arriving in 2025 on a relatively weak footing. Uncertainty is the only certainty An undersupply of newly built housing. This is another factor which will strengthen the market. An undersupply of newly built housing is likely to provide some support for housing values. Although population growth is expected to ease further in 2025, a cumulative undersupply of housing has accrued across Australia, following the record levels of population growth since international borders reopened. The residential construction sector continues to face feasibility hurdles in getting new housing stock to market, materials and labour costs having surged over the past 5 years. Given the highly ambitious target to build 1.2 million homes by mid-2029, the potential, I picked up an error, they said 219. The potential for new supply-side stimulus policies aimed at kickstarting residential construction activity is highly likely for 2025. So, of course, there is factors that are going to be protecting the market as well. Interestingly enough, I caught up with one of our long-standing members, Daniel Ferruggio, in Melbourne. Is Daniel here? Okay, we'll have a chat to Daniel. Don't come to the screen just now. I want to chat to you when we talk about the market, because he's been in the downturn for, I think, 8 of the 12 months or whatever it did say. But he's not seeing like an awful market. It's been workable. Because of those reasons that I've mentioned, there's still tightening and labor shortages, and stock, has risen, but not dramatically. How are we doing for time? Okay. So let's have a look at little old Perth, because most of you are from little old Perth. So let's look at that. Okay. Early signs are starting to emerge that the surge in Perth residential property market may be starting to slow, which could be good news for those struggling to get a foot on the ladder. We'll talk about that in a second. Most notably in the past 4 to 5 weeks. A decrease in purchase from the East Coast and less activity from buyers agents. We'll talk to Ash about that, because his market has been dominated by Eastern States purchases. REWA data provided to your money reveals 58% jump in property listings between the end of August and October. That coincides with the increase in the median days to sell, number from 9 to 13. So it's not rocket science to see the trend where it's going. So we were down to 2,798 properties for sale in Perth in May. Then in October, 4,929, and last week, 5,651. So clearly trending upward. Okay. Let's have some more. Intel under historic averages. The trend is, while the figures are still well under historic averages, the trend is upwards. The real estate experts have previously stated Perth's equilibrium is 12,000. I reckon the equilibrium is around about 10,000, but they say 12. I think 12 we're struggling, okay? But I may be wrong. 14, it's a shit show. So 14,000 properties and we're in dire straits. 18,000 and you guys are not eating. It's that simple. But there's always the Real Estate Brilliance members who do better in slow markets, and we're going to talk about that today as well. And I've got lots and lots and lots and lots of examples, including myself. While I am no soothsayer, I would suggest that we may look back at this time as being the peak. And that's why Ryan Thompson sold all his investment properties, or his trust's investment properties, and moved into a lifestyle position to set myself up for the next 5 to 10 years.